For those of you who are on today, my name is Pierre Debbas. I'm a real estate lawyer and co-managing partner of a real estate boutique firm in Midtown Manhattan called Debbas. Currently, we're a firm of about 25 attorneys focusing on all transactional elements of commercial and residential real estate in the New York City area, as well as throughout the country. Our practice heavily emphasizes on representing buyers and sellers of residential and commercial properties in the New York area and several some of the biggest lending institutions in the country in their commercial financing related matters, which is what we're going to focus on today. Our firm also has an extremely active real estate related litigation practice, focused on every aspect of real estate litigation that takes place in the tri-state area. So that's a little bit just on us. Myself and my other named partner, Michael Romer, have been very active participants in the expo for about probably over a decade at this point. I remember, bouncing around from Columbia University to the Hilton on 6th Avenue to the New York City Bar Building. And, luckily, it looks like we'll be gravitating towards doing this in person again come the fall, where we'll be having, some of the biggest names in real estate on a whole day event. So for those of you guys who are attending on Zoom, thank you for doing this. It's a nice way to kind of, stay in touch and, get in front of a lot of people in this new virtual world we live in. I'm excited about the topic today that we put together, talking about what the roles of the agency lenders in the multifamily market, which has been having a record, couple of years. And clearly, liquidity in that marketplace stems from Fannie Mae and Freddie Mac, in something that, I have two of the best in the industry, and Brian Walton and Austin Walker from Greystone and Arbor, respectively, to talk about deals that they're seeing, what they're seeing in the market. We have a number of very timely and interesting points to bring up. And then I also have one of my favorite people, Carmen, Pagan, in our law firm, who heads our agency and lending practice for Debbas. So it'll be a great conversation. We're going to keep it pretty fluid. Unfortunately, we're not able to do Q&As with the Zoom setup the way it is. So if you do have questions, you maybe put them in the message board. I'll be checking that message board to, see what questions pop up. And then at the end of this session, all of you will get all of our information. So if anybody has any specific questions for each of us individually, feel free to reach out. But before going further, Austin, you're on the top of my little box here on my screen. Let me throw it to you to give an introduction on yourself first, and then we'll throw it to Brian, and last but not least, Carmen.
Yeah, absolutely. Well, Pierre, thank you for having me. I really appreciate it. Glad to be here with the expo and sharing whatever I can, just on the state of the market and Arbor. So myself, I've been originating at Arbor for, going on about 8 years at this point. So I focus predominantly across most of our platforms, which is Fannie, Freddie, which is the majority of our business, and our structured transactions. We're one of the most active bridge lenders in the industry. So I focus on everything from, transitional housing across the country, value add projects, some opportunistic stuff, and then, the other, core part of our business, obviously permanent agency loans and supporting housing. That's, in a nutshell.
Cool. Brian, let me throw it over to you.
First of all, thank you again, Pierre, for inviting me here on the expo. This is my first time and very excited to join you guys. Similar to Austin, working at Greystone for about the last 10 years, focusing mostly on stabilized Fannie and Freddie lending, working with a large group that originates over about $1.5 billion of originations a year, doing everything from recaps, acquisitions, refinances, bridge lending as well. Also do HUD financing and FHA deals. So started off as an underwriter initially, underwriting, learning credit parameters, understanding the guide, how to package these loans to sell, and then moved over to Originations about 5 years ago. And since then, been just mostly focusing on, originating and building client relationships.
Cool.
My name is Carmen Pagan, and I am at Debbas, and I am a partner, and I lead a team of all diverse women group. I have been working on real estate industry for about 21 years. Really excited to be here today. Thank you for having me, and let's start the conversation.
Cool. So the first thing I wanted to post to all of you, clearly in the last 2 years, we've had the most robust housing market and also investment in the multifamily sector than we've ever seen in the country's history. And it's been kind of, an oxymoron in a sense, because rentals and home purchases both skyrocket simultaneously, which is somewhat counterintuitive, right? Like usually when the housing market is so robust, renters are becoming buyers and then demand of rentals comes down and vice versa, right? And one of the biggest problems that this is, causing is an affordability issue, because at the end of the day, who's the one suffering the most in terms of, interest rates almost doubling and where price appreciation has gone in the last 2 years. So I know a big initiative of both, Fannie Mae and Freddie Mac has been focusing on the affordable housing market. Talk to us about the products that Fannie and Freddie are offering in affordable housing, how this is helping create more inventory in affordable housing, and where you see that marketplace going. I'll throw it, Austin, I'll throw it to you first if you kind of want to, chime in. We'll get Brian's thoughts as well.
Without getting, too down in the weeds, Fannie and Freddie have both have phenomenal executions that support both the two sectors within the affordable housing space, which is, capital A affordable, your LIHTC, true HAP contract, LURA restricted rent properties, whether that's on the new construction side or the permanent refinance, side of it, and doing preservation deals for HAP contracts that are still, where they're going to get in their compliance periods and certain things which have favorable pricing, favorable LTV, DSCR parameters, which allow you to get, a little bit more leverage as an operator in certain instances. And then secondarily, workforce housing and naturally occurring affordable housing has been really the key focus, especially this current FHFA administration. We've retooled the affordability calculators to capture, even high cost markets where, you have really cost burden, segments in these high cost markets, which tweaking those AMIs allow you to actually get certain rent pricing credits and certain things that qualify under mission, affordability metrics for Fannie and Freddie. So they continue to innovate and actively support that business. But it really touches on all the facets, within that affordable housing space. I'm sure Brian can add a little bit more there.
Sure, Austin. I mean, you pretty much hit the nail on the head with that. I mean, that's really the main focus of the agencies. Like Austin mentioned, not to get too in the weeds of things, but there's a big tool called the affordability calculator that the agencies really reference when they're looking at pricing, leverage, or just how to even just compete in the market, which is so interesting because most banks are probably just looking at just specific returns, right? Cost of capital, lend money, get paid back. The agencies, on the other hand, also look at, how do these rents look compared in the market with, the average median income, rents at other properties that are comparables, and how they are able to really provide that liquidity is by maybe lending in more tertiary markets, smaller areas where the liquidity isn't that maybe prevalent with small and local banks. So they're able to both provide liquidity and affordability by both being out and major purchasers of these MBS securities in the market with their obviously implicit guarantees. And as Austin mentioned earlier, he hit the nail on the head. They're like in this current administration, they're every year while they are both, increasing and decreasing caps and making stuff uncapped and more capped. And there's so many different ways to even measure that. The one thing they've been consistent on is the amount of affordable units that they want to keep increasing every single year. So they definitely have shown a commitment into giving, favorable financing to property owners that are looking to preserve affordable rents. That's really a tough mission for them right now. I would say that they probably struggle with. I even know after speaking with my counterparts over at Fannie, they're looking at me to say, hey, how can we do more affordable housing? How can we find more affordable units? Because another topic we can get into later on this call is it's kind of counterintuitive to the value add that we've been seeing a lot of across the country, where you have seen incredible rent growth. So you're trying to weigh out the benefits of providing somebody liquidity and incentivizing pricing, but then also you see record-breaking rent growth in some of those same markets where people are looking to go in and capture some of that. So it's very, very interesting. I think they're doing a great job. I think that, it's just more difficult, as you mentioned, how the factors of home pricing increases and rental rates increasing, that their job is going to become more and more important in the future, especially over the next 2 years. How they really step up and promote affordable housing is going to be key.
And Brian, what markets are you seeing the most activity in the affordable sector?
Sun Belt, Texas, Tennessee. Like, I mean, you know, you saw a lot of people in the Northeast area kind of get out of this area, like when the rent stabilization laws in 2019, and you start seeing sub 5 caps here, even as rates were going up in 2019, where you saw the Treasury almost hit 3%. When the Treasuries tanked below 1 back in, you know, middle of COVID, I really start seeing a lot of people buy in Georgia, Florida, Tampa, opportunity zones in the Southeast. Carolinas are crazy in the sense of just seeing consistent double-digit rent growth.
Mm-hmm.
But that's just me and my anecdotal way of saying that's kind of where my clients really are playing in the space. I mean, also may hear about other areas on the West Coast and maybe Midwest, but I'm seeing a lot of Georgia, Florida, Texas, Alabama, Tennessee, where we're starting to see really strong rent growth.
And Carmen, let me ask you this: in terms of capital allocation for agency lending, clearly we've seen, you know, a huge shift towards the affordable market. Where are you seeing deal flow wise in your perspective in terms of, you know, what percentage of deals out there in the marketplace you say are affordable versus conventional, you know, so on and so forth? Like where would you break down the allocation of deals?
I think there's going to be a big increase in affordable housing because that's the commitment from the administration and the agencies. I think the agencies have become very creative in providing incentives to motivate developers to allocate more units to affordable housing. So there's going to be a big increase in the affordable market. And, you know, the agencies are mission driven. They're, as they mentioned, they have this workforce initiative that borrowers volunteer to dedicate certain units to affordable housing. And even in the local government, like HPD is also developing this inclusionary housing that, you know, they use like a quid pro quo, they get a tax abatement or some tax incentives in order to provide more affordable housing units. And I know the mayor of New York has also committed to increase the affordable market units, and you know they're talking about converting abandoned hotels into affordable housing, and it's a big initiative at every level.
Yeah, no, it's interesting you bring that up because, you know, clearly densely populated cities like Manhattan have a number of hotels and potentially even office buildings at some point that are going to be vacant or have, you know, distress related to them. And there's talks about, you know, what to do with them. You walk around Midtown Manhattan, you'll notice a handful of, you know, major hotels, you know, that are boarded up and vacant, and we're in year 3 of the pandemic. So it seems like it's an opportune time to take those assets and, you know, utilize them in a way that could benefit society more so. But, you know, we'll see. There's been a lot of talk of that. I can see it happening with hotels, given the fact, you know, how they're configured in their Department of Building Regulation and meeting more of a habitable requirement as opposed to offices. But I haven't seen it done yet. I don't know if any of you have, but it's definitely something I think that's going to be a good thing to watch out the next couple of years.
And even retail, all these malls that are empty and that, you know, are vacant, they're trying to do something with them, and affordable housing is probably one option.
Right. Let me ask you all this. You know, with everything going on in the industry, you know, I know for the bank's perspective, bridge loans have become a lot more popular in the last year. Explain to everybody, you know, kind of what the bridge product is. Why is it becoming a focal point in this market? What's been transitioning, you know, borrowers to go for a bridge product as opposed to traditional conventional financing, and where you see that, you know, playing out in the increasing interest rate environment moving forward.
You know, we've been in this period now, especially, you know, over the last 2 years, where, you know, with the precipitous decline in rates from COVID and Fed stimulus, you've seen probably one of the most unprecedented, you know, runs of cap rate compression in our industry across the board. A lot of that is just, you know, demand from folks migrating from, you know, urban cores into other areas, as Brian was touching on earlier. So what's happening is in, you know, say traditional, you know, 6 cap plus markets, you know, those same properties today are trading at in sort of a 5 cap, you know, range, or in some cases slightly below that. And the reality is, right, either you have two options. It's either contribute more equity because your debt cover constrained on say a straight 10-year deal on a 30-year AM, and now you're seeing that increasing with rates going up. You're just debt cover constrained on these deals, so operators can't get the leverage they need. So what ends up happening is, the bridge is an incredibly powerful tool because it's a short-term vehicle which allows you essentially to look at a business plan, and I'm going to take rents from where they are today to some point slightly elevated in the future. I'm going to deploy a certain amount of capital, and as a lender we could finance the business plan, right? We use appraisals. There's a lot of fundamental analysis that goes into it to get comfortable around the credit, but we're essentially able to lend today's dollars where we will ultimately be able to take them into a Fannie, a Freddie, or an FHA execution, say 2 or 3 years down the line. So it's a tool to get dollars today to purchase an asset based on where you'll operate it a little bit later. And in a low cap rate environment, you have to do it. I think one of the biggest challenges, that's sort of happening today too, is just sort of what's happening in the underlying CLO markets, right? With spread widening and it's something that I think there's a little bit of fissures going on in foundation that we'll see how much volume has come into the system on new issuance over the last 2 years has been unprecedented. It's grown to the tune, I think 50 plus billion is what the CLO market is right now. That was probably a third even 5 years ago. So that, and you've seen a lot of secondary trading activity, so that's pushing. You're starting to see, new issuances widen out for new issue CLOs. So, that's where the large majority of fundings come from, is in the CLO market for bridge lending. And that we're starting to see that, tighten up quite a bit. So I'm very curious, personally, I don't have a crystal ball, but I'm very curious to see where it heads in the next, even in the coming weeks, as we sort of reset the landscape and just kind of, see if sellers kind of get realistic about pricing and how that'll happen. But, we've seen a little slowdown in refinance activity but folks are still buying deals, and there's a ton of dry paper out there, still looking for deals, and, cap rates haven't widened out nearly as much as rates have gone up over the last few weeks. So obviously, that's driving the demand for the bridge product at the fundamental level, but, structurally we'll see how long it sort of holds up. And I think you could see a little bit of softening in the acquisition markets as we kind of work through this. So that's where we are for bridge, at least.
Well, Carmen, how have you seen the underwriting and the requirements of borrowers differ between, bridge loans and conventional loans? Has there really been a difference in that regard?
I believe there has been a difference because when you borrow from a local bank as opposed to the agencies, the underwriting is a little different. Local banks have more flexibility. Agencies have a different outlet. But in general, I think because of market conditions and interest rates hiking, in general, I think that agencies and bridge lenders also have eased a little bit the underwriting requirements, and they're trying to compete in a market that is competitive. It's also affected by interest rates, and everybody wants to remain profitable and keep lending and keep the market moving.
Right.
And the strategy that they use in order to attract more borrowing.
Right.
Yeah. I'll add to that too, because Carmen, you really hit it on the head. We've seen it even internally, with our credit, because of how many debt funds and other CLO lenders who have gone into the business, like Greystone, like Arbor, we've been around for a very long time. We've gone through multiple market cycles where our teams are very adept and entrenched in this industry. And, we know where to look, we know where distress, kind of comes from, and have a pretty good handle on where not to overextend, and what, we have seen and are seeing is the competitive landscape for this product is maybe pushing some debt funds and some folks, further down the credit scale, where, you may be reaching for a deal that probably should be a pass from a credit perspective, but are still getting done in some instances. And that's where I think, you'll start to see a little bit of widening in terms of who's going to continue putting money out on the street, and who will sort of survive any real material shakeup in the marketplace.
Brian, talk to me about interest rates, because this is obviously one of the biggest topic going on in the market right now. You're comparing bridge lending to traditional commercial real estate finance lending. Where are you seeing the difference in rates between the two products, and how have you seen the sharp increase in interest rates in 2022 impact valuations of properties?
So just to piggyback on something that Austin mentioned that I wrote down, because it's actually very interesting, because we all have been doing it, but not realizing that the bridge lending that I think that makes it so unique is because you are underwriting a business plan. And I wrote that down because it's so interesting, because in my first part of the career, just really focusing on the agencies, you kind of underwrote into a box. If the sponsor had, the net worth and liquidity and the property's covered at a 125, you almost was delegated to take that deal through your servicing company and close and fund the loan. As it becomes more complicated, I'm starting to compete against Arbors and the different types of capital sources out there. You're starting to realize that sometimes it's the market, or it's the sponsor, or it's there's so many different areas of credit parameters that you're now looking at to make bridge lending work, which is, like Austin mentioned, that some of these new players that are coming in maybe be focusing on one thing too much, or maybe not focusing enough on another. So it's really interesting to see, kind of how these loans shake out, because the one thing that I also wrote down, and this is a great segue into your question about the interest rate, is that like when this pandemic first started, bridge rates were inside of agency rates, because the agencies implemented what they call floors at the time. So even though the Treasury had hit, I think it bottomed out at around maybe 50 basis points back in April or May, on a 10-year deal, you still needed to underwrite to a floor of, call it 90 or 1%, in which to where they were basically calculating their refinance risk by not lending somebody a 215 rate and then, maxing out proceeds, but in 10 years from now, you have to refinance at 6% and then you not being able to exit. So I think that was a phenomenon, at least that I saw initially, that you saw bridge rate, which quote unquote, the term bridge is supposed to be, more of a riskier type lending, pricing below what stabilized lending was pricing at. So now, as Austin mentioned, that has probably widened now. I know there's been a couple of CLOs that have gone into the market recently where warehouse lines have been kind of, mispriced. And now we're going to start maybe seeing the bridge price, 400, 450 over SOFR or LIBOR, depending on where you're lending from. Whereas, back 6 months ago or a year ago, they were probably closer to 275 to 350. Now, the going in Fannie Mae 10-year rate right now is probably, with good affordability, probably around 4.5. So while it's still, bridge is still technically slightly above it, at least it's like, I think, pricing itself to where it probably should be. I think spot SOFR right now is around 80 basis points. So maybe bridge lending right now is maybe closer to 5.25, whereas agency stabilized is maybe 4.5. So there's about a 75 basis point delta between the two. And that's kind of where I think it should price. I think especially now, as Austin mentioned and Carmen mentioned as well, that the prices of assets haven't really come down with where rates and stuff have been going yet. And I think now we're going to potentially start seeing them, more people look into more stabilized financing, the 10-year money, the 12-year money, because it is cheaper. And, obviously seeing where rates are going, they're going to look to probably lock something in. Another key feature about variable rate loans, after talking to my clients about, was the flexibility. When there's a lot of uncertainty in the market, a lot of the prepayment penalties for variable rate financing are usually minimum yield of 6 months to a year, and then 1% or a certain percentage of your unpaid principal balance, versus the agencies have defeasance with Freddie Mac and yield maintenance with Fannie Mae. So I've seen a lot of borrowers, take bridge lending because they say, well, in 3 or 4 years, I don't want to be stuck with a 5 or 10% yield maintenance penalty that, can throw off your sources and uses or your exits, depending on kind of where you are in your business plan. But regarding the bridge activity, I still see a lot of clients reaching out, asking for it, even as rates have gone higher. I think it's due to that flexibility of prepayments. And I do think it's still the most leverage that you're still going to get. I'm still seeing most deals penciled with the agencies at around 65% leverage. So unless you're coming in with, big 1031 monies where you don't want to take the tax liabilities and you'll buy a lower cap rate, I'm still seeing them gravitate towards, financing the business plan to get 75% of costs or 80% of costs. So I've not seen that business slow down just quite yet.
Right. No, it's a very super interesting perspective. Another thing I wanted to kind of pick all your brains on is that clearly a huge topic in this space is, will Fannie and Freddie come out of conservatorship? And there's been a lot of rumors going around town that is back on the table again. We all know the Supreme Court's ruling that took place last year, stating that that they're going to stay in conservatorship. What are your thoughts in terms of the likelihood of that happening? And how if it say it does happen, how would that impact the commercial lending market and in their ability to lend? I know it's a loaded question, so I'm gonna. Someone's have to rip the Band-Aid off and take it.
Yeah, I mean, I saw it when we sent over kind of some talking points, and it kind of even kept me up last night, just really thinking about it. There's so many different ways to think about the business model. Is one in which to where we do need the liquidity. I can see it being a profitable business outside of conservatorship because it already is one now. Mm-hmm. I just I don't really know kind of how much of the market share they'll still be able to continue to have with shareholders, with certain investment returns and metrics that are maybe not privy to us as it's still technically under conservatorship when it becomes like a public company with shareholders. So I would love to hear what Austin and Carmen maybe think about it. But for me, it's not a big conversation starter, but I'm not really sure, I guess is the answer. It's like it's very much up in the air.
I did preface to that it's a loaded question. So.
Yeah.
I do commend you for being the brave one to take it first stab.
I mean, I'm not even trying to get political about it. I do think coming out of conservatorship could be a good thing for the companies, but I don't know, what it is for the markets per se.
Right. Well, Carmen, I'm going to throw you on the spot.
I think it's going to be good to come out of conservatorship. These agencies have demonstrated after the issues they had in 2009 and years after that they have performed well throughout the years. They are led by savvy people, good entrepreneurs, and I think in general the public get a little nervous whenever an agency like Freddie Mac or Fannie Mae or another agency is supervised by another agency, by the government. So I think that when both agencies went into conservatorship, the public was a little nervous. What's wrong with the agencies? And I think coming out of the conservatorship will then assure the public that these agencies are doing and performing well. They are fulfilling the mission for what they were created back in, I think Fannie Mae has been like 33 years. And later Freddie Mac was formed, but I think that it will be good for the market. I think it will be good for the market.
One thing I have that I find it very difficult in answering this question as well is I'm so entrenched in the multifamily business of Fannie Mae and Freddie Mac, but when you go look at their balance sheets, it's a huge national lending company as well that does mostly single families type homes as well. So I'm assuming when you talk about exiting conservatorship, the health of that part of the business is just not one I'm very much privy to know they're like seeing where housing prices and stuff have done over the last year and a half or 2 years, 3 years, how does that part of it look? Because they're still buying and government guaranteeing, hundreds of billions of dollars of single family mortgages. That's also being weighed in this decision. So I feel like my points about, their strengths of dividends and interest payments that they've been receiving and how strong their multifamily portfolio makes a lot of sense to me. But I've never had a chance to do a deep dig and analysis to see how does this play into its entire function of, housing in America. So that's why it's always so interesting to me.
It's a great point you bring up because, when you compare it, a big topic I've been talking a lot the past year is comparing this robust housing market to the housing market pre-financial crisis. And, one of the common, themes in every conversation is that the biggest differential is that prior to 2008, the lending was absolutely reckless in the single family space. It was just, no income verification. The appraisals were handled in a very, unethical manner. And, it was just, pumping money into the system. And again, the only way to phrase it is in a reckless manner. And when you look at present day, clearly this housing market is, significantly higher than what we experienced prior to the financial crisis, but lending's at a very healthy level. So it appears, in today in comparison to back then. I always give a great example, when we used to review contracts for, residential acquisitions back in, 2005, 2006, there's a provision in a contract called a mortgage contingency clause. And back then it was the one provision that nobody ever read, because we never thought about having mortgage contingency because it was a guarantee you were going to get a loan. And, I'm extraordinarily thorough. When I was a young attorney, I had every word of a contract memorized, like I knew the thing inside and out. And then all of a sudden, we know what happened in '08, and I get my first contract on my desk having paragraph 18 or 23 or whatever the paragraph number was. I'm like, oh my God, I don't know what that says, because I haven't read it in 5 years, because we didn't even have to worry about it because it was a given. That's what happened back then. You didn't even think twice that you were not going to get a loan. And, loan to value ratios were more aggressive. And I feel like in today's market, the approach has been a lot more conservative, where clearly the issue is that the pricing is appreciated so drastically in the last 2.5 years. And I don't know about all of you, but when we had this pandemic hit in March of 2020, I certainly didn't forecast residential real estate to be arguably the biggest beneficiary of the pandemic. No one would have thought people would have scattered all over the country, bought homes, and working from home would become the norm as opposed to the minority of people, right? And what happened also too, the economy, or not the economy I should say, but the stock market doubled during the course of the pandemic, and liquidity was created, and we printed trillions of dollars, and cash was thrown into the system, and people bought housing. And I thought that there'd be a plethora of layoffs taking place. I didn't expect the Great Resignation to become something people would even fathom to do in the middle of a crisis. And housing is skyrocketed. And that's kind of, posing a lot of concerns out there that, are we in a housing bubble, which, Brian, would impact what you're talking about in terms of, the ability to come out of conservatorship, should this actually be another bubble? I'm one who doesn't necessarily believe that we are in a bubble. I think we've created a new norm in a lot of ways. But Austin, before I, continue going down this road, I want to get your thoughts on the question too. If you don't.
I think you're just bluntly put, just to keep it as simple as possible. I think it's just a vote of confidence. Coming out of conservatorship means that, both agencies are incredibly healthy and operating and functioning properly. I think it's generally a good thing.
Yeah. I mean, it certainly seems that way because, we are, what are we, 14 years, after this originally took place. Taxpayer dollars have been refunded, repaid with interest and extraordinarily handsome returns and dividends.
I think that's, part and parcel, maybe why they're still in conservatorship, right? The government is enjoying a very healthy return on their position.
It's been a hell of a return, Austin. It's been a great return. I mean, I don't know how else to phrase it, quite to put it bluntly. So yeah, I mean, it'll be interesting to see. I definitely think that the next year or so, in terms of the stability of the housing market, again, to Brian's point, will play a huge role in terms of whether that will take place or not. But again, I know you guys don't focus on single family housing, more so multifamily housing. But I mean, I'm sure you're hearing through the grapevine and through your channels at the agencies that the lending criteria has been different. And I follow a lot of the Freddie Mac and Fannie Mae economists on the internet. And they have phenomenal statistics, showing that this does not appear to be a bubble. If you don't mind, I mean, I know it's kind of segueing a little bit, but talk to me. I mean, what are your guys' thoughts on on housing? Because this impacts what we're talking about, in the grand scheme of things.
Yeah, I think where we are at a price level. I think you actually started the conversation more in line with kind of where I think we're going in terms of multifamily. I think this increase in pricing for housing affordability in terms of residential housing is again now becoming a little bit more unobtainable in terms of in the backdrop of where interest rates now are for residential home mortgages. It's I think, I was talking to one of my buddies who's, one of the top realtors in New Jersey, and he's even seeing it, get a lot softer in sort of the under 1 million. I think when you get over 2 million, between 2 and 5, those are typically your cash buyers. But in that, mid range and small range of pricing, it's still very much elevated, although, inventory, you still have an inventory problem, right? That's the biggest thing is you can't build these things fast enough in markets and desirable areas with desirable school systems where people really want to live, essentially. So I think we've, to your point, set a new floor under where pricing is. I think ultimately it's just going to continue to drive demand for rent or push out homeownership, even more into a permanent, renter position. I just feel
right,
like
which only benefits the multifamily market because
right.
would-be buyers don't have a choice to whether to buy or not. They're forced to be renters given what's going on.
Absolutely. Now, SFR and build for rent are becoming the fastest growing asset class in the multifamily sector. And there's a reason for it, right? The first movers in that business was Blackstone and Imitation Homes and, all of these other large institutions have been way ahead of this trend, right? Yep. This is nothing new. This is something that's been evolving since 2008, and it's now just becoming commonplace. And there's more liquidity from debt products available to SFR operators, and we're just seeing it more and more that this is going to become the new normal. And frankly, I think even for the younger generation and look at what we're doing on a virtual panel for this virtual conference. Our workforce and our ability to work remotely but still be plugged in and do what we need to do. We could do it from anywhere. And that transient nature is that's one of the benefits of being in a renter, sort of position as opposed to owning a home, right? I can up and pull my house off its roots and move it where I want to move it. So that's, I think we're sort of in this lane, and it's just going to continue to move that direction.
Also, that's why I continue to be very bullish on the multifamily market because, if you read the stats, we're right now, given where housing demand is, we're about 5.5 to 6 million houses short of meeting current demand levels. Mm-hmm. Clearly, demand is going to decline with the way interest rates are going, and also in any bull run of any market, there has to be a slowdown or an end in sight. But even if demand declines, substantially, one of the ripple effects of the financial crisis is that housing was not created in the last decade, right? There was not development because after subprime lending, we thought we had a glut of inventory in the country. And we thought there'd be a plethora of availability throughout the entire country after that. And that, in fact, has not been the case 10 years later because essentially, development has become stalled. And what that's going to do is forcing people to rent for probably the majority, if not their entire lifetimes. Because when you talk about the 1 million submarket, that's a majority of transactions, and where the majority of homeowners can afford is sub 1 million. And when interest rates go up, the 30-year fixed rate was about 2.8%, 6 months ago, maybe not, which sounds crazy. And now it's hovering about above 5.2. Who's impacted by that delta in the carrying costs the most on a mortgage? And again, what happens to that person? They stay renting. And I think that's the trend you're going to see for the foreseeable future. We have a couple of minutes. We have about 3 minutes left. I know we talked about a lot of things. Brian, Carmen, are there any other anecdotes that you wanted to share? Anything we didn't talk about that you think would be, interesting for everybody viewing today?
Well, I think that the multifamily business is always historically has been coming out as a winner. And I think that I remember in 2009 when the economy tanked and Fannie Mae came up with the securitization in the capital markets program. And, throughout the years, they have reinvented themselves, and Fannie Mae has the delegation, the DOS delegation. Freddie Mac is talking about launching a similar product, and they have created these C-based financing, all green rewards, and they're trying to stay up to date in the market. So I think that the multifamily business will continue to grow, and we will be the beneficiaries.
Ron, any parting words you want to share with everybody?
No, I agree. I appreciate you inviting me on. This has been very thoughtful, and I love this conversation. But yeah, I agree with Carmen's sentiment. I think that one of the questions you asked is how some underwriting criteria have changed to meet, some of the new changes and prices and cap rates and things. So I just think that, the agencies are creative, entrepreneurial in the sense of I've seen them even now, look at different ways to make transaction works with longer amortizations periods, looking at, you know, different types of ways to promote affordability through that SIA program that Carmen mentioned, with giving pricing to owners that want to create affordable housing. So I think that, you know, we're in a good spot, like you mentioned. I think that I think in the next 5 to 10 years, even with the headwinds that people are talking about now, including rates and where prices and stuff are, I think that like there's just going to be a strong demand for this product going forward.
I definitely agree. So for everybody attending, you know, if ever, you know, if you're in the multifamily market or working with clients in that sector, you know, Brian and Austin are two of the best in the business in terms of financing and capital. So I definitely would highly recommend reaching out to them. Brian, Austin, Carmen, thank you for doing this. It was a lot of fun talking to you. Your insight, I personally found to be very helpful. I'm going to steal some of your anecdotes in my next interview, so don't hold that against me.
Look forward to seeing you on Bloomberg.
Thanks, I appreciate it. And Anthony, let me throw it to you to kind of give some parting words.
Pierre, now I know where you got your smarts from. These guys are awesome.
I talk to people smarter than me. That's my trick.
I was going to say, I know where you got your law degree from. Brian, you guys are Brian, Carmen, Austin. You were a joy to listen to. Yeah, thank you, guys. Thanks.
Very welcome. Thank you for having us.
Really, you guys know your stuff. Take care, everybody.